Welcome to the deep dive. Today, we're tackling Circle Internet Group, ticker CRCL. They've been on a really wild ride since their IPO back in June.
Oh, absolutely.
I mean, if you've been watching, the stock swung from, $31 all the way up near $300 a share. It's been quite something.
It really has. And look, if you're trying to figure out whether Circle is a good investment opportunity and they're right at the center of this whole stablecoin thing, then, well, this deep dive is definitely for you.
Right.
Our mission today is really to give you, the listener, a clear picture of what actually matters when you're weighing this up.
Exactly. We're going to unpack Circle's latest numbers, their Q2 2025 results, and look at what the experts are saying. Is it this, golden buying opportunity? Or is it more of a crypto headache, as some are calling it? We're using Circle's official Q2 earnings report and some recent analyses from Seeking Alpha to piece this together. So let's dive in.
Okay. So, at its heart, Circle is a global financial tech company. Their big mission statement is about raising global economic prosperity through the frictionless exchange of value.
Frictionless value exchange.
Okay. Essentially, they're aiming to build the biggest, most used stablecoin network out there.
So let's talk about the core product then. What is it and how does it work for someone maybe less familiar?
Right, that's USDC. It's their main thing. Think of it like a digital version of the US dollar. It's designed to always be worth exactly $1.
Always $1.
And the crucial part for you as an investor is understanding how it maintains that peg. It's backed one-to-one by reserves.
Okay, reserves. What kind?
These are mostly held in really liquid, very low-risk things. Think short-term U.S. government bonds, cash, that sort of stuff. It's all about stability and transparency.
That backing sounds, fundamental. How does Circle actually turn that into revenue? How do they make money?
That's the absolute backbone of their business model right now. Most of their revenue comes from the interest they earn on those reserve assets.
Ah, okay. Sort of like how a bank earns interest.
Exactly like that. They do have some other revenue from things like transaction fees, integration services. But right now, that's a much smaller slice of the pie. The yield on those reserves,
Yeah.
that's the engine.
Got it. Now, let's look at Q2 2025, their first report as a public company. The growth numbers, on the surface anyway, look pretty strong. USDC in circulation, for instance, grew 90% year over year.
A massive 90%. Hit $61.3 billion at the end of the quarter. And it kept climbing, reaching $65.2 billion by August 10th. That's significant growth.
Wow. And what about overall revenue?
Also strong. Total revenue and the reserve income component were up 53% year over year, hitting $658 million.
Okay.
And their just EBIT, which is a good measure of core operational profitability, that grew 52% year over year to $126 million. That shows good operating leverage.
Meaning their revenues are growing faster than costs.
Precisely. Improving efficiency. The reserve income itself jumped 50% year over year to $634 million.
And that other revenue bucket you mentioned, the
Right.
smaller one.
That actually surged, up 252% year over year to $24 million. That's coming from subscription services transactions. So you see some early signs of maybe diversification starting there.
Okay, strong growth.
Yeah.
But there was a pretty big net loss reported, right? About $482 million. That seems like a disconnect. What's the story there for an investor?
You're absolutely right to flag that. It looks jarring next to the growth figures. But, and this is critical for you to understand, that loss was, as they put it, significantly impacted by almost $600 million, $591 million to be exact, in non-cash charges related to the IPO itself.
Ah, okay. So not from the day-to-day business losing money. What were these charges specifically?
Well, the biggest piece, $424 million, was stock-based compensation. Think restricted stock units, RSUs.
Yeah.
That vested simply because the IPO happened. The conditions were met.
Okay, that makes sense. And the rest?
The other $167 million was an accounting charge for the increase in the fair value of their convertible debt. And that value went up because the share price increased after the IPO.
That's kind of a consequence of the IPO's success, ironically.
Yeah. In a way, yes, these are accounting impacts, not necessarily bleeding cash from operations. Understanding that distinction is, well, it's vital for assessing the company's actual health.
Okay. Beyond the numbers, Q2 was big for them corporately, too. They pulled off that $1.2 billion IPO in June, sold shares at $31, brought in about $583 million net. That's a strong market debut.
Definitely. And then there was the Genius Act being signed into law. That's huge. It sets up a federal regulatory framework for stablecoins like USDC.
Right. How does that impact Circle directly?
Well, Circle noted that the act pretty much just codified what they were already committed to doing in terms of compliance, reserves, audits, so it validates their model.
That sounds like a major de-risking event, almost a stamp of approval. What else was going on?
They launched the Circle Payments Network, CPN, back in May. Already has 4 active payment corridors, and they mentioned over 100 financial institutions are in the pipeline for the second half of this year.
Building up the network.
And they introduced something called ARC blockchain. It's an open Layer 1 blockchain, purpose-built, they say, for stablecoin finance. Expected to hit public testnet this fall, and USDC will be its native gas token for transactions.
Interesting. And they've been busy with partnerships, too.
Yeah, announced new or expanded deals with some big names, Binance, Corpay, FIS, Fuzzerv, OKX. It paints a picture of a company really pushing to expand its footprint and infrastructure.
Okay, so that's the setup. Now let's get into the arguments. Why are some investors looking at Circle and seeing, a golden opportunity? The bull case.
A big part of it is their market position and just the sheer growth potential of the stablecoin market. Analysts like KM Capital point out USDC has a solid market share, somewhere between 24% and 28%.
And the overall market projections are, frankly, staggering. McKinsey thinks stablecoins could hit over $400 billion by the end of next year, 2025, and maybe $2 trillion by 2028.
Huge tailwinds. And here's an interesting point. Even though Tether's USDT might be bigger by market cap overall, USDC actually leads in the number of transactions.
Oh, really? Why is that significant?
It suggests USDC is really being used heavily in areas that demand more transparency and compliance. Think DeFi, US-based exchanges, fintech integrations. It's seen as the more regulated, transparent option.
Which ties back into that Genius Act we mentioned. The bulls see this as a major competitive advantage, right? Like a moat around their business.
Exactly. Column Research called it a major tailwind. It basically validates Circle's whole compliance-first strategy they've had for years. The act requires things like 100% reserves, audits, daily redemptions.
The stuff Circle was already doing?
Precisely. So it gives them a leg up immediately over competitors like Tether, who haven't always had the same level of transparency around reserves.
So the argument is this act gives a kind of legal green light for banks and traditional finance to jump into stablecoins.
And when they do,
Circle, with its track record and now regulatory blessing, becomes the obvious first choice, the clear default.
that's the bullish take. It's a huge validation. But it is interesting, as you hinted before, how that same regulation kind of locks them into this interest rate dependent model. It's a double-edged sword investors need to weigh.
Definitely. Okay, what else fuels the bull case? Is it just about USDC yield?
No, and this is a key point for the bulls. Analysts like James Ford argue the potential goes far beyond USDC reserve yield. They're looking at Circle's newer initiatives.
Like the API services.
Right. API-based services, programmable payments, smart contract infrastructure, digital treasury services for businesses.
So the idea is these could become major revenue streams down the line.
That's the projection. Some analysts think these other segments could add maybe $5 billion in revenue by 2030. That could push total revenue towards $12 billion.
Wow.
One analyst even used this powerful analogy. Circle is building a Visa plus Swift plus PayPal all in one within crypto.
That's ambitious. A really bold vision for diversifying beyond just clipping coupons on reserves.
It is. And finally, there's the valuation argument from the optimistic side. They acknowledge the near-term multiples look high, a price-to-earnings ratio of maybe 117.
Yeah, that sounds steep.
But the argument is you should expect significant PE compression, meaning earnings are expected to grow so fast that the multiple will come down sharply in the future. They might project, say, a forward PE for 2027 around 35.
So the idea is pay a premium now because earnings will catch up and make it look cheap later.
Essentially, they frame it as investing in a pioneer in stablecoin infrastructure. You can't really compare it directly to traditional fintech. It's a bet on the future shape of finance.
Okay, that lays out the bullish perspective pretty clearly. But we need balance. Let's flip the coin. Why are some investors calling Circle a crypto headache? What's the bear case?
The absolute #1 concern, you hear this from analysts like Bears of Wall Street and Sophos Research, is that extreme sensitivity to interest rates.
Because that's where almost all their revenue comes from currently.
It's exactly. Somewhere between 90% and 95% of their revenue is dangerously concentrated in that interest income from reserves.
So if rates drop?
It hits their bottom line hard.
Huh.
A 1% drop, 100 basis points, could slash annual revenue by $400 million to $700 million. That's potentially 25% to 40% of their 2024 revenue gone.
And have we seen any impact of this already?
We have. Their Q1 results actually showed a $102.6 million revenue decrease, specifically because the average yield on their reserves fell by about 97 basis points. So it's not theoretical.
And the critique is that the Genius Act, while good for legitimacy, actually forces them to keep reserves in those short-term assets.
Which means they can't really hedge against falling rates effectively. It maximizes their exposure. That's a fundamental structural challenge for the bears.
Okay, rate risk is clear. What else worries the bears?
The Coinbase revenue sharing deal. This is seen as a major structural flaw. Coinbase gets up to 60% of Circle's reserve revenue.
60%. Wow, how much does that translate to?
In 2024, Circle paid out $907 million to Coinbase under this arrangement.
Why do they have to do that?
The argument is the Genius Act prevents stablecoin issuers from offering direct rewards or interest to holders. So, to get distribution, Circle will have to partner with platforms like Coinbase and share the underlying reserve revenue. Bears see this as permanently compromising profitability.
And Coinbase holds a lot of the USDC.
Yeah, Coinbase holds about 18% of all USDC in circulation, apparently, compared to Circle only holding about 2% on its own platform. So Coinbase is capturing a much bigger slice of the economic value created by USDC reserves.
It does sound a bit like, as you said, Circle built the highway, but Coinbase owns most of the toll booths.
That's a good way to put it. Then, naturally, there's the valuation concern from the bearish side.
They see those high multiples differently.
Very differently. They point to a trailing PE, maybe around 600x, which is exceptionally high, a forward PE still over 100x, an EV/EBITDA multiple around 83x. These are all way above typical fintech or even crypto peers like Coinbase itself.
So they think it's just too expensive, regardless of growth.
Right. Some bearish analysts, using discounted cash flow models like Sophos Research, come up with an intrinsic value somewhere in the $131 to $142 per share range. That implies, significant potential downside from where it might be trading.
They'd say it's priced for perfection.
Exactly. The current price assumes everything goes right, leaving no margin for error or bumps in the road.
What about competition? Does that factor in?
It does. Tether's USDT still has a much larger market cap, roughly $163 billion versus USDC's $64 billion. And USDT dominates in many offshore markets.
Why is that?
Partly because it's available on more blockchains, including ones like Tron, which are popular internationally. Circle made a strategic choice to get off some chains like Tron and Algorand to boost its compliance profile.
So strengthening regulation, but potentially sacrificing some market reach and liquidity compared to Tether.
That's the trade-off critics point to. It allowed Tether to consolidate its lead in certain high-volume, maybe less regulated corridors.
Okay. Any other major risks the bears highlight?
Just the general stuff. The stock is clearly volatile. There's a dependence on the health of key partners like Coinbase, Binance. And, it's still an early-stage business in a new asset class with a brand new regulatory landscape. There are inherent uncertainties there.
So putting it all together, for you, the investor, it really feels like a crossroads.
It really does.
On one side, you've got this compelling vision, Circle as maybe the foundational plumbing for a growing digital economy.
Yeah.
Strong recent growth, huge regulatory validation with the Genius Act. That's appealing.
But on the other hand, you absolutely have to weigh these immediate challenges. The heavy reliance on interest rates is undeniable. The Coinbase revenue share is a significant drag, and that valuation is, demanding, to say the least.
So the core question for you listening right now is this. Do you believe Circle's long-term potential, this vision of being the glue of on-chain finance, is compelling enough to navigate the current volatility and these known structural issues?
It really boils down to a bet on the future, doesn't it? A bet on market growth, on Circle successfully diversifying its revenue away from just yield versus the very real present-day risks around interest rates and profitability structure.
Okay, so we've really unpacked a lot here. We've dived deep into Circle's Q2, looked at the bull case, the bear case, drawing from the report and analyst views to give you that comprehensive picture of the investment opportunity.
And here's something to really chew on. You have the Genius Act seemingly cementing Circle's regulatory standing. You have analysts talking up this potential hidden revenue engine from software and services down the line. Does that combination signal that Circle truly is the future infrastructure for digital finance?
Or are those current dependencies, the interest rate vulnerability, the big chunk of revenue going to partners like Coinbase, just too big a hurdle for your specific investment goals and risk tolerance right now? What does all this mean for you deciding whether to step into this evolving stablecoin world with Circle?
It's a fascinating puzzle.
We encourage you to really think about whether Circle's long-term strategic vision resonates with you enough to outweigh those clear short-term risks, and whether it fits your own thesis for where the digital economy is heading.